Share. We're pleased to welcome now Jeremy Nelson, partner at Element Wealth. All right, Jeremy, good to see you. Thanks for coming in.
Always a pleasure.
So I'm just sitting here watching the markets in the studio. I know that's what you do for a living every day. There's been a bit of a sell-off in the last week, to say the least.
Yeah, I think that this is, it's kind of in line with what we talked about at our economic forecast, was that, look, if you're going to make an omelet, you got to crack some eggs. And I think that markets they're expensive, right? And I think what you're seeing right now is some of that premium that's built into stocks getting sucked out. People are getting a little bit more conservative. But overall, I think markets have held up pretty well. We've seen, tech stocks get hit harder. They're in correction territory with the NASDAQ. But overall, the S&P 500 hasn't, we're not in correction territory there. And I think you're seeing a little bit more of a rotation out of some of the high-priced tech into, some more value names that are out there right now.
How do you figure it out? Because and this is what I mean by that, there's mixed messages somewhat. There's mixed messages certainly with respect to timing, with respect to what the president's done via executive order, and the prospect of perhaps that getting struck down by courts, and then, of course, the cooperation of the Congress to codify his agenda.
Yeah, I think, what we've seen over Trump's first term, over Biden's term, was a lot of executive orders. And then the thing about executive orders is they just get unwound.
Yeah.
Right? And we're really trying to create permanent stability in reducing the deficit, shrinking the size of the government. And, some of this is going to have to be ratified by going through Congress so that we can be on a sustainable foot for the long term, so that we don't get, 3 years down the road and everything just gets turned over.
Right. All right, so we got the GDP that we're paying attention to somewhat, and the Atlanta Fed is predicting negative growth, a contraction this quarter.
Yeah, so originally they came out with a negative 2.8. It was revised this week to negative 2.4. That GDP now forecast tends to be a little bit extreme. So it's extreme on the up and extreme on the down. So I don't really believe that the economy is going to contract 2.4% in the first quarter. But I will say that, we've been surprised over the past 2 years at how strong GDP growth was, but it was all on the back of this excessive government spending. So, at our forecast this year, one of the things we said was, if we are retracting on that government spending, then we expect GDP to slow this year from the level that it had been in the past couple of years. So
sure.
I think it's consistent with our idea that if you're going to go in and take a hatchet to the federal government and all that spending, it's going to create more unemployment. It is going to slow down the economy a little bit. I think that the bigger concern is people start really rolling back because they're uncertain about tariffs and are we going into trade wars? And there's just a lot happening from a geopolitical perspective. And if that leads people to slow down on their consumption, then it could lead to a recession.
And I'm not sure if they're an outlier among the regional feds, but I think at least one other is predicting an increase, a growth.
Yeah.
Some growth in GDP, right?
Yeah, so that's, like I said, I think we're going to have slower growth, but still growth right now. So I don't really pay too much attention to that GDP now forecast because, again, we were seeing last year where it was coming out and saying it was going to be 4%, and it wasn't. They're always high and they're always low. So,
well, and of course we've got the old nasty R word popping up again, the possibility of a recession, right? A lot of indicators maybe pointing to that.
I'm not sold that we're there yet. I think that the concern would be that you get a stock market that's correcting.
Okay.
And so kind of like the recession that we had in 2001, a lot of people think the recession in 2001 happened because of 9/11, but we were actually in a recession when 9/11 happened, right? So all that was the wealth effect, right? The stock market was going down and people started pulling back on consumption. The risk would be here that the stock market starts going down, that premium that's built into it starts getting sucked out. People get concerned. Their 401ks are going down.
Yeah.
And then they slow down on consumption. But other than that, I mean, the economy's still on pretty good footing. I mean, unemployment is still very, very strong. We still have a structurally strong
today, right?
Yeah, and it was a little bit weaker than anticipated, but it was, I mean, everyone knew it was going to be a weak number.
It was the New York Fed, by the way, that predicted we would have healthy growth, and we got the Atlanta Fed. So this reminds me of what I share on the show all the time is economists have two hands, of course, because anytime you make a prediction, you always have to say, on the other hand, though. So
yeah, like I said,
because it's a forecast.
I'm still in we're going to have growth. It's just going to be a little bit slower, but I think you're going to see market volatility, and if that market volatility gets too extreme, you could start to see an impact on consumption.
Well, there's no doubt if folks are checking their retirement accounts, a lot of our audience, of course, they're still working. They're building up their accounts, and they're checking them, and they're getting nervous. What would you tell them?
Well, number one, you got to remember where we came from. I mean, the last 2 years have been pretty good, and markets don't go up in a linear fashion. Right? You got to deal with it. This is why you diversify. But if you're getting closer to retirement, you really need to think about the mix of stocks, bonds, alternatives, things in your portfolio. You shouldn't really be solely reliant on what the stock market does for your retirement.
Mm-hmm. Yeah, and I think that's good advice. But nonetheless, people get antsy, especially those that are getting close to retire, right?
Yeah, but you can't panic, right? I mean, that's the thing is that if you go back throughout time, I mean, we had the dot-com bubble crash. We had the Great Recession. We had COVID. We had 2022, right? I mean, ultimately, time heals the wounds, right?
Okay.
You just got to make sure that you don't have so much risk in your portfolio at or near retirement that, a bear market is going to force you to go back to work, right? So that's where diversification works. And one of the things that I've been talking about for a couple of years now is that stocks are actually really over-owned, right? If you look at the percentage of household financial assets that are in stocks, it's at a record high. Whereas bonds are actually well below the long-term average. So there are alternatives out there that are safer, that can still provide you a reasonable return and keep things going forward.
Mm-hmm. Okay. What are your thoughts, I guess, about the government really getting serious about not just trimming spending, but more importantly, trimming deficits, because it's deficit spending that necessitates borrowing, and borrowing typically is inflationary.
Well, I mean, look, at the end of the day, you're talking about a near $2 trillion deficit. You're talking about more money going to interest on the debt than military spending. Like, that's upside down, right? That's a problem, and you have to do something. And the fact that we haven't done anything for so long is why the actions that are being taken are so draconian, because you really just have to – there's no choice now. You can't slow play this. You really got to get in there, and you got to deal with this from a spending side. Now, what we all have to recognize is that that's going to be a little painful. Like, you got to crack some eggs to make an omelet, right? And some eggs are getting cracked right now. But there's a necessity to getting this under control, because for the long-term future of the country, you can't sustain 6% of GDP deficits when you're not in a recession.
Right.
That's asinine. I mean, we're talking about the only time, that's a bigger deficit than in the Great Depression. The only time we had bigger deficits as a percentage of GDP was World War II. And I would say back then it was understandable.
Yeah. And you're absolutely right. We are on track, according to the latest Fed data, for a $2.5 trillion deficit this particular year.
And you have to get that under control. And if you go in and you just tax to do it, then you're killing the economy, because you still have to grow.
Yeah.
So you have to cut spending.
Yeah. Hang around. We'll keep talking about all this stuff. We got Jeremy Nelson, partner at Element Wealth, in the Element Wealth studio. We're coming right back. SuperTalk Mississippi, Jeremy Nelson, partner at Element Wealth, is our guest. So let's talk for a minute about interest rates. That's something folks are always interested in, no pun intended, in understanding at least the trajectory, the trend. The 10-year, I really thought would be over 5, and it never got to that point. Got bumped right up against it, I believe, and now down 4.2, 4.3,
Yep.
something like that. Maybe indicates investors are a little squeamish about the GDP, the economy, the overall health of the economy. The Fed, if we do in fact experience a contraction, will they react with a price cut? That went from no chance to, where are we now, 33% chance or something like that coming up?
I think the Fed is going to be forced to cut later in the year. But the challenge there is that in the short run, you still have inflationary pressures, right? I mean, if we start implementing these tariffs, which we have, you're talking about massive increases in prices on certain goods that we're importing because we don't have the supply chain set up to build it here right now, right?
Yeah.
So that in the short run is inflationary. And then if we do, reshore a lot of these manufacturing jobs and build more stuff here, it is going to be more expensive. It is going to be somewhat inflationary, and that makes it hard for the Fed to be able to cut. Now, long term, yes, that's very beneficial, right? But I think that what you're seeing with fixed income is the Fed's having to kind of anchor down here. The yield curve is flattening, right? The long end has come down. That is a level of demand, right? People are buying bonds for safety, right? So I think there's an aspect of some money's coming out of stocks, it's going into bonds for the safety there. And I think that the longer-term inflation expectations are coming down a little bit because there is that concern of more of a deflationary, recessionary period that's starting to get priced in a little bit on the long end of the curve.
Yeah. Well, that makes sense. In the meantime, you wonder to what extent major purchases are just kind of being paused because of this, with the expectation that we may see some lower rates later on in the year.
Well, I mean, the housing market is just kind of dead right now, right? And people are hoping and waiting that interest rates are going to come down. I think that I think auto sales are going to be real tough.
They're going to get ripped.
I mean, they're just going to get ripped.
No doubt about it. That's just
what's
the reality.
Going to happen. I was talking to a friend of mine that owns a tire store, and I was like, I think business is going to be good for you because people are going to be holding on to their
vehicles, changing their tires
for a lot longer.
But even if we get lower interest rates, let's say with respect to the housing market, we're looking at the possibility of increased construction costs because of the tariffs.
And this is one of the challenges, is that we're not, despite the fact that there's not a lot of activity in housing, prices aren't coming down a ton. Now on the upper end, they're soft, and if you want to sell, you're going to have to sell for a discount. But on normal, middle class homes, they're still moving. But people are having to spend more of their income on housing because those prices are not coming down. And some of it is just that people just aren't selling, right? If you've got a 3% mortgage, you're just not selling, right? You're just sitting on it. So there's not a lot of...
Many can't afford to.
There's not a lot of inventory right now.
Yeah, but if, there's a lot of folks that 3% mortgage is in line with their qualifications for a loan.
Yeah.
And even if they move to a house of a similar value and cost, it's 7%. It's unaffordable.
It's not.
They're not getting the financing.
Yeah.
And they may or may not have enough equity in the existing home to roll into a new one to drive their overall principal down to offset the increase in the interest rate.
Yeah, people are stuck. And I will tell you, I mean, I've got a lot of clients who are coming to me right now who, they're upper end of the economy. And they're kind of talking about their household budgets and cutting back.
Yeah.
It is a major topic of conversation.
Well, that's not good for retail sales as well. As you know, consumer confidence, it's pulled back significantly over the last month. And now there's also a lot of reports we've seen, I know you have as well, that the weather had a major impact on retail sales, et cetera. Over the last month. I don't know if that's true or not, if it's anecdotal, if that's universal.
I think it's anecdotal. I mean, there's always weather.
Yeah.
I mean,
right.
I don't know that this February was really any different than last February or the February before. Like it's weather. It's the winter.
Tax cuts. It's something we talk about on this program all the time, how critical we believe it is that at a minimum, the existing tax environment, which really isn't even cutting taxes, is just keeping everything the same. But the way the CBO scores it, it's as a tax cut because it's scheduled to expire, so you start that cycle all over again, the analysis. How much do you think, Jeremy, that the market is kind of taking a wait-and-see approach on that? Little nervous. The Senate comes out with a bill, doesn't have any mention of tax cuts in it. The House is still devising its plan.
Yeah, I think the market is, again, holding up pretty well there and in kind of this wait-and-see mode. My take is, my expectations and what I believe the market expects is that whatever we end up getting is going to look a lot like exactly how it is today.
Yeah.
I don't know that there's room. So if we think about these cuts, right? So the Doge, okay? My estimation is that they could cut out about 25% of the deficit, not 25% of government spending, 25% of the deficit, which still leaves us with a significant deficit.
That's right.
And so further tax cuts from this point become really, really difficult to put through. And that's why you're seeing the House and the Senate really struggling with this, and there hasn't been a ton of movement, whereas everyone kind of expected they'd get something done really quick. It's not happening because there's still this deficit, right? And if you cut taxes much more, then it's going to keep that deficit. So I think that the fiscal conservatives are saying, hey, where we are today from a tax policy is pretty good. We need to hold here. Going further is going to be very difficult because of the deficit issue. And so if we hold and grow and cut 25% of the deficit, we can start over the next, 5 years maybe to get to a point where we're normalizing the deficit.
Yeah. Well, and in addition to just that reality, you've got the situation where you've got to come in within certain constraints and parameters to be able to pass the legislation in the Senate with a simple majority.
Yeah.
So for the benefit of our audience, I know the president has talked a lot about tips, overtime, Social Security being exempted from federal income taxes. He mentioned it numerous times. It's very popular, as you know. Mm-hmm. But when you start doing the math and trying to fit that in addition to keeping the existing tax structure in place, then you start to exceed the parameters that would allow a measure to pass in the Senate, yeah, on a simple majority.
Yeah, it's just, it blows the deficit out.
Yeah, and it also, it's about $350 billion a year.
Yeah,
is estimates I've seen.
And that's the big challenge, right, with further tax cuts, because the hole is so deep. Yes, it would be awesome to get, but all the good of the cuts are going to be then gone, and we're going to be in the same place from a deficit perspective.
Yeah, exactly.
And we have to. And I think that, I go back to 1980 and Ronald Reagan. Okay, hard decisions were made, right? And markets were a little negative. We had a slowdown in the economy, but we kind of got things right, and then from there we're able to move forward. And I think that that's a bit of the period that we're looking at here, is that you can't just wave a magic wand and fix all of this. Right? There's going to be consequences. Now, it's important for the long term, and I do find it interesting now how President Trump, in his first term, the stock market was his barometer. And now he's saying, I'm not looking.
Yes, Treasury Secretary said it.
Yeah, and so there's no presidential put under the market. I mean, he's dead set on getting this done.
Yeah.
And if it means that there's a bear market in stocks or that premium comes out of it, he's okay with that right now. And I think that investors have to be prepared for that. And it's very different than the optimism in November when he won, or in August when he went up in the betting odds. I was like, oh, it's going to be great for the stock market. And people are realizing there might be a little bit of pain here.
Well, he even said you're seeing a lot of market reaction to the expectation that I'm going to win, right?
Yeah.
And that's when the market was
Yeah.
trending upward quite a bit. But now they're not quite as comfortable just because of the uncertainty, I think, more than anything.
Yeah, the entire bump has been washed out.
Yeah, completely.
Yeah.
We're back to kind of where we were.
Yeah.
Well, it'll give us a lot to talk about, that's for sure. Jeremy, always appreciate you coming in and sharing your insights. Thanks a lot.
Appreciate it, Gerard. Thank you.
Jeremy Nelson, partner at Element Wealth. Once again, we're in the Element Wealth studio, coming right back.